Okay, so here's a question from Klaus, Roger. Can you tell us what you think are the major market risks and opportunities at the moment?
Okay, the biggest risk at the moment is that there's not a lot of value around. And that's why we're seeing, for example, so much interest in the new floats. To give you an example, Veda, which is the credit rating company that'll be listing shortly, the retail component of that float was only about $35 million. And I'm told that the bids for that $35 million exceeded $1 billion. So what's happening at the moment is the only game in town, if we can describe it that way, and I hate using that phrase, but the only game in town for professional investors, because there's no value elsewhere, is the floats. And many fund managers are being quite aggressive in bidding for these floats. And it's not unusual to bid for $5 million worth of stock and only receive maybe $50,000 worth of stock or $100,000 worth of stock. I'm happy to report we've been allocated a reasonable amount and we're happy with our allocations, but it's pretty tough out there. So the major risk is that the market is expensive. The other major risk comes from the fact that a bubble forms when fads become silly, when fads get to that silly stage. And the fact that interest rates are so low on term deposits, people think there's no alternative but to get into stocks. And that's flawed thinking, because a 3% positive return is a darn sight better than a negative 15 or 20% return, which is entirely possible in stocks, and it seems like people have forgotten that. They just think, oh, the yield on Telstra and the yield on the banks is better than money in a term deposit, that's where I'm going to put my money. Commonwealth Bank, if you look at Skaffold at the moment, we can do this. We'll do it. If we go to Commonwealth Bank, CBA, click on Evaluate. The Commonwealth Bank's premium to intrinsic value at the moment, if we scroll down here, you can see it's 23%. See down the bottom of the screen there? 23% at the moment. There's only been 3 other occasions in the last decade where it traded at a 21% premium or greater to intrinsic value. And that is in 2006 here, in 2007 there, and in 2010 here. They were the only other 3 times in the last decade that the CBA has traded at that substantially a premium to intrinsic value. And on each of those 3 occasions, you can see the share price fell by 15% or more after that. Now, I'm not suggesting that the share price for Commonwealth Bank is going to drop, Chris, but what I am saying is that the risk of a negative return is greater than the risk of substantial upside. You know, the positive scenario is less likely than the negative scenario.